Most investors follow the dictum, got a hunch, bet a bunch.
Without completely revisiting the last video, in a nutshell, I made the case that gold and silver mining stocks represent one of the greatest opportunities I see in the precious metals area. It seems whenever I talk about mining stocks, you as an audience divide into basically two camps. The got a hunch, bet a bunch group, as Rick Rule said, or you're kind of like what Ice Cube said in the movie Boys in the Hood. Either they don't know, don't show, or don't care about what's going on in the hood. I had to sneak that in. Either way, here's the reality. I don't want you to be in either of the extreme groups when it comes to mining stocks. Let me give you a little analogy here. Your physical gold and silver are like having a perfectly cooked ribeye dinner with a side of fluffy mashed potatoes. And if that's all you had for dinner, you could go to bed very happy with that meal. But what always happens? The server comes by with a dessert tray. Do you really need dessert? Lord knows I don't. But regardless, we all take a look. Now, if you're not big into desserts, this isn't the time to exactly, get adventurous and stuff. All you need is a solid, good dessert to top off your meal. It doesn't have to be amazing, it just can't suck, and you would be very, very happy. I want you to think about mining stocks like your dessert. All they have to do is outperform the physical metal, and that most of the time they do. What we're really talking about is this age-old debate about seeking market beta versus alpha returns. The terms alpha and beta are used by investors to classify the performance and the risk they are seeking, with the beta being the sector average and alpha being exceeding the sector average or exceeding the beta. Going off what we discussed in the last video, investing in the SIL Silver Miners ETF would be considered your beta investment, while buying First Majestic and Pan American would be considered your seeking alpha investments. And the returns, as you can see, is, well, one achieved the alpha and the other didn't. Now let's get back to the premise that started all of this. The divergence between metal spot prices and the price evaluation of the companies that dig up those metals and bring them to the marketplace. I've put together a chart for you in TradingView. Look at 2020 where everything plummeted. SIL went right down with the silver price, and for a while they were very closely connected, and then the silver gray line, which is the silver price, stayed elevated while the SIL fell off a cliff in mid-2022. In this slide, I measured the difference in performance, and it's almost half in terms of percentage. This, my friends, is what we call an arbitrage, and this is exactly where we make the easy and the best money in the marketplace. Just for the ETF to return back to trading with the silver price, an almost 50% increase has to happen. These stocks have historically performed very well.
From 1976 to 1980, gold stocks rose by 800% per the Barron's Gold Stock Index. From 2000 to 2008, they quintupled. From 2009 to 2011, it quadrupled. In just 7 months in 2016, they almost tripled.
This is the type of opportunity when the game of investing really becomes fun. This is exactly what Rick Rule looks for. Don't forget these words.
What this chart points out to you, silver rewards you infrequently, but when it does reward you, it rewards you exorbitantly. And the up move is so dramatic.
This is also what Rick Rule means when he talks about shifts in the market where the easy money is made.
I love stuff that's hated, where if the narrative changes from hated to neutral, I get a triple.
Going back to where we started the video with Rick Rule talking about got a hunch, bet a bunch, listen to what he says next.
Some investors, as a consequence of the fact that they understand that they don't know enough themselves, don't invest at all. In other words, they miss the alpha and they miss the beta. But for the vast majority of investors, the vast majority of investors, capturing the beta is all they need to do. For those people who are deeply involved and deeply interested, for those people who are willing to spend an hour a month on every position in their portfolio, those people could and should take more risk to generate alpha, but only those people.
We've all heard the phrase, a distinction without a difference. Let me tell you, what Rick just shared was a distinction with a huge difference. You don't need to get cute here. I would submit to you that the arbitrage has already been created simply needs you to focus on the beta, because for SIL just to catch back up to silver means SIL will greatly outperform the price of silver. This is critical because one of the biggest counter arguments that I hear to investing in mining stocks is the associated risk, especially if you're buying individual companies. Well-known fund manager Adrian Day sums it up very well here.
In a gold fund or even an ETF, you will get the kind of performance that will make most investors perfectly happy.
The beauty of ETFs and mutual funds is that you don't need to know how to pick or evaluate companies. You just need to know that there's an opportunity in the sector. The arbitrage between mining stocks and gold and silver prices, in my opinion, has taken away a tremendous amount of the downside without sacrificing your upside. Now, if you're like me and a little more aggressive and want more or greater leverage growth, this is where individual stocks make sense. But you've heard me say this before, and it bears repeating. We have to stop thinking like stackers and start thinking like investors that stack gold and silver. Mining stocks need to be viewed within the context of your overall portfolio. Some of you might remember a video I did a long time ago where I gave you my precious metals allocation rubric. What we have here is a rubric based on a mix of physical and equity holdings. The rubric is based on the performance you seek and whether you're choosing to be an investor or more of a speculator. Now, this is not a one-size-fits model. It's a model that I've developed for me, and I'm only sharing with you to help you conceptualize, because this is not investing advice. You are your own investor, and you have to own your own results. I think the best way to view this is to start looking at the beta investor quadrant and determining what percentage of your dollars do you want to allocate to this quadrant. Then within that quadrant, you can consider an 80-10-10 split. 80% physical gold, 10% mining majors, royalties and ETFs, and then 10% of maybe more speculative individual gold stocks. Now, if you want to stack silver, silver moves you into the beta speculator area, and you have two ways to consider investing. It's important to know that the 70-30 split is in the context of your silver allocation. Let's say that you have a 70-30 split of gold and silver. Of the 70% that you invest in gold, you then need to determine the 80-10-10 split of that 70% split. God, I hope that makes sense. Your allocation to silver is going to be, let's say, 40%, or let's say $400. Then you have to decide how you're going to spread that $40 amongst the 70-30 split. Now, along the top of this grid, you have the alpha investments of platinum metal groups. And I don't pretend that this rubric is going to work for everyone. In fact, what I really want you to do, create your own rubric for your particular goals. For example, you might be a 100% gold investor, so your rubric may look like physical representing the bottom left quadrant, and then GDX royalties are your bottom right quadrant, and your large gold mining stocks are your top left for alpha investments, and your alpha speculator may be junior mining stocks. Ultimately, I don't know what's best for you or your situation. What I know is that as investors, we need to be diversified and capable of seizing the opportunities the market presents. While we need our physical gold, silver, and platinum as our base, we just can't ignore the leverage growth and the opportunity mining equities are creating. This arbitrage is significant. You don't need to be a stock picker, but you do definitely need to be in an ETF, mutual fund, or some kind of royalties, because these opportunities in the motor markets don't come around very often. In the comment section, do you buy based on a portfolio allocation? What percentage of your stacking budget are you setting aside for mining stocks? Or simply put an A+ in the comments so that everyone knows that you always stack smarter and never stop learning.